let's make it official. Yes, there we are. Okay, it is a little after 2:30 p.m. Eastern Time on May 14, almost the Ides of May, which is much less well known than the Ides of March. And I'm Tim Quast with Market Structure Edge. Welcome. Nice to have you here today. I've got a number of things to cover. And, our only two rules, if you would, mute yourself while we're talking. And number two, please fire questions at me. I would love to hear what you're thinking. And if you have observations, please share them. And we'll proceed from there. Okay, so let me share my desktop because I'm going to begin with SPY. So, it's the only ETF we have on the platform. Why don't we include them? Because they would demolish our ability to understand demand and supply. They're tracking instruments. I won't, recapitulate all the ways that ETFs work, but the basics of ETFs are there are two parties in the wholesale market to them. Let's just say BlackRock and Morgan Stanley. And so if BlackRock is selling an ETF to the public, Morgan Stanley is going to gather some assets that reflect what BlackRock wants. BlackRock will publish to the unit of the DTCC, the Depository Trust and Clearing Corp, a grocery list. It will say, maybe it's S&P 500 stocks, but it will say these. And so then Morgan Stanley may or may not have those. They may say, well, we don't have those, but we have these. But whatever the case, the value of the basket of stocks, $10 million, will be the same value as $10 million worth of ETF shares, and they will swap them. And so now BlackRock owns the stocks, Morgan Stanley owns the ETFs, and they sell them to you and me. And there are a lot more nuances to how that market works, but therefore, ETFs are tracking instruments, and they have a propensity to hew to the mean, to the middle, whereas the stocks have all the movement, bouncing from 1 to 10 from a demand-supply perspective. And that's how Jane Street makes money. If you've read that Jane Street made close to $40 billion last year, much of that comes from having great models that look for, those stocks are below the ETF, let's go long those. Those stocks are above, let's short those, and let's trade the ETF versus options or whatever. So that what you're trying to do is capture spreads, little tiny spreads. And so the market has this propensity to mean revert and have limited standard deviation. Very rarely does the market have 5 standard deviations, right? The trouble is it's very unpredictable. The efficient markets hypothesis has been largely debunked because you can't predict why the market would do something like it's doing now, which is very inefficient, or why it might have done something like this back here, which one maybe could construe was efficient because it gave everybody an entry point. If so, that's why we don't put ETFs on the platform. My point with SPY is look at this. So this is back to the last time it was below 5. It will spend most of the time at 5. As I've said before, the market is heavily dependent on large caps and their growth and value. What do you get if you have large cap blend stocks? Probably 5s. So the SPY will reflect that and be at 5s most of the time, save where there are demand imbalances there, and here. We've had no real supply imbalances, so to speak. But look at the supply trend. It has been steadily down. In fact, it's at levels that we saw when the market was at a steep bottom and had corrected. And it tells us that the steady reduction of borrowed stock in SPY has played a key role in its steady upward march. Now, I don't know what that means, but we're going to zoom in here in a little bit. But this is 54 weeks. 54 weeks is not the longest ever. That was in 2020 and 2021 when it spent 60 weeks at or above 5. Well, it's a very long time. So if we zoom in now, let's just zoom in for a month because you can use SPY as a very good short-term indicator of how the market will go. If there is a strong increase in demand and a decline in supply, you have a very high confidence that the broad measure is likely to rise. If supply rises and demand bottoms, then the broad measure probably stops rising until supply declines. Then it rises again. Here we had this dip in supply into options expiring, and it's been another good run for the broad measures. But you can have a really high level of short-term confidence about the direction of the market by looking at that demand-supply relationship. And you have to zoom in for the short term. Now, what would cause that to break down? You know, it's difficult to say these days. You know, we could go back and look historically, but clearly, when one of these things changes in a material way, what's that? What will that mean? Well, you know, a breakdown below 5 would be very material. It still hasn't happened in well more than a year. Well, a little bit more than a year. And a steep increase in supply might be it. I don't know that it's a great signal for risk. It is a great tool for short-term, broad-based understanding of where the market's likely to go for 1, 2, 3, 4, 5 days. I think broad sentiment, which is looking at the basket, is a much better read on risk, because this is a proxy. It's very liquid. It expands and contracts to accommodate money, and that doesn't tell you about risk, but it'll certainly tell you what the market's general propensity is. Okay, now, next thing, I'll pause. Questions, comments? Since I have no sidekick, I'll have to watch for questions. Brad, yes. Okay, let me get to your question. Okay, let's see. The NVIDIA being in over 1,000, it's almost, you rounds to 1,000. So does that act as it's the technically Microsoft is in 3 more, but NVIDIA has pounded, I mean, it's past everybody. And at the rate it's increasing, it will absolutely be the world's most widely held stock. Plus there are 24, you know, I've said this before, 24 billion shares of NVIDIA outstanding. It's astonishing, right? And look at it. So it has created an immense capacity to expand its market cap. There's a lesson to me for other public companies. But anyway, to your point, is that does that act as a balance for the stock? If so many ETFs own NVIDIA, who's exactly? That is exactly right, Brad. And in fact, it's something I have traded notes with a couple of Wall Street Journal business writers that I have known a long time about. You know, you look at it and say, why hasn't anyone rebalanced? You know, there's a legal requirement to do that. Now, they can stretch the limits. You could go technically up to 70 days after the end of a quarter if you're an index fund before you run the risk of, if the regulators ask, of not having squared your holdings, generally speaking, to your prospectus. Doesn't mean you have to hold everything proportionately. Could be baskets of options and futures that will get you there. But now, why isn't anybody rebalancing? I mean, if you know, Intel's up 100% in a month-ish, who else has run like that? AMD, we're going to look at these. It's one of my core points. Wouldn't you want to rebalance? Not only is it basic human common sense and a manifestation of fear and greed that you would, but you have a legal obligation to your holders to do that. But I think you're exactly right, Brad. I believe that people are fearful in the bowels, the machinery of the equity market, about doing it for fear that it could cascade. I mean, suppose everybody in those ETFs rebalance, that would be a problem. And we'll talk about that. I'm always thinking about the risk. You know, I like taking gains, not chances. And I look for those kind of macro risks. And it is something. And we'll talk about that more. So yes, I'd agree, Brad. It's a ballast. That brings us around to the stock market. Let's go to broad sentiment. Move this out of the way. So broad sentiment, you'd think, I mean, at the rate the broad measures are rising, why isn't this a lot stronger? I mean, you would think this thing would have taken off. I mean, we had during the pandemic, the bounce out of the pandemic, 8s, you know, we got to over 8. So, you know, we'd go to below 2 and all the way to 8. Tremendous momentum. And you'd look at the market and say, well, it's got the same momentum. It does, but it's very isolated. It's not broadly there. If you were to take the stocks comprising this green measure that we call market structure sentiment or demand, it's metering behaviors plus average prices. How do those behaviors move like pistons and impact average price? And that's how we get to this measure. And interestingly, if you were to look, we run this, that data comes from here. So this is our Azure, it's just a SQL service, reporting service, SQL, you know what I mean? Yeah, it's a reporting service. So I can look at the raw data. It's not pretty, it's the database, but there's that number for today. Here's the interesting thing. Over here, if you look at the daily read, it actually declined. You look at the market and go, well, how could that be? Because if you look at the whole market, not semiconductors, and we'll look at this, the whole market is not awesome. The 200-day average price, if you added all the components up, is 217.88. The record was, I think, around February 27-ish. My memory serves, and my memory's aging and given to error. 227. So 217.88, 50-day average, 217.88. I don't know what the mathematical probability of the 250 being the same, but they are. The 20-day was 222.66. The 5-day is 222.40. So that's the problem, that if you take the whole aggregation, and yesterday, 10% of the S&P 500 hit 52-week lows. So there's a lot of stuff in the data that doesn't comport with how well the benchmarks are performing. And it illustrates, as I've talked about ad nauseum, that ETFs pick the basket. They're not picking Accenture and IBM. They're picking Lumentum and SanDisk in the basket. And so it inflates the broad measure and leads you to believe something that may or may not be true about the broad market. And if you take all of the large caps, which you can do, all I did was go to Edge here. Let me navigate away briefly. And I dumped my mega cap portfolio. This is loading slower than I would prefer. And I talked to Eden about this on last Tuesday, that we have a Kubernetes cluster shift that we're doing, and it's had a little impact. So this portfolio, mega caps, 100 billion or more of market cap, it's 136 components. That's off the high, got as high as 144. And you can export that, which I did, and then you can tally the market cap of that group. Well, it's shocking to find that it's 65 trillion, right? Like in 136 stocks, there's $65 trillion, and their average demand is 6. It's topped. Now, I don't know what's going to happen, but I look at all these things because I like to not be caught up in the frenzy. And there is absolutely an AI frenzy, and it is spilled into a Cisco. Intel, you can see where it spills, and that's fine. We can be catalyst traders as well. But I also want, what we have always said is we want to be prudent. Wise as serpents, meek as doves. We got to know what's going on so that we're not caught out there over the skis, which the whole market is. It's not an opinion. It is a basic reflection of fact. That it is that if you're going to invest $1 trillion in something that 2 years from now could be substantially different, it's not a wise investment. You don't know what the capacity and usage is going to be. It's never the way we deploy capital. I don't care how good the opportunity is. We're not going to build capacity for 3 years from now. Not going to do that. That ties your capital up and exposes you to risk. And yet all of our leading companies have done that. And I don't think it's a good thing. I think they're smart people, but you can start, believe in your own press releases. So my point out of this is you have to keep in mind the whole big picture. Now let's zoom in on the semiconductors, because that's where all the action is. So I have this, SOX. I think there are 32 in the SOX index, so I'm missing one, and I haven't taken the time to figure out what it is. But you can see there's all the heat, right? You have steeply declining supply and tremendous pelting demand that has not broken down at all. Lasted, back here in early April, just before everything took off. This was the creation of stock to fill excess demand. I mean, it wasn't, there are no sellers and tremendous demand, so market makers create stock. Then they covered it all in here. That covering event, these things are exact opposites of each other. So I know that they have met their legal obligation. And now we have a little change in it. I don't know if that's the end, but you can know this at any given time, and it's a huge advantage for you. And if you think it's a good advantage, tell somebody else. But it's pretty awesome to know how stuff is performing. You can go look at how many things are at 10, and it's a great tell. Let's just look at, and I like to look at it in the bigger view here. So let's just take Micron, which is, look at that, rapidly approaching $1 trillion of market cap, over 900 billion. And you will know right away, well, is this stock still doing well? Yes. No, there's no hesitation. You can see that it's a pounding 10, has been for the better part of 30 days, and supply continues to trend down and is below the trend and pulled a Hicks sort of move down. So I look at that and say, now, could it be late cycle? Well, yeah. I mean, it's a very, very long time for a stock to be at 10. But you could look at the same, remain safe owning Micron. And you can do this with anything, right? You can look at AMD. Are we safe owning AMD and trading it? What you want to do is benefit from the things that are rising, but make sure that you're not caught out like people who are not aware of how the market works. Well, look at this. I mean, it's just been unbelievable, the demand and the steep decline in supply. Now, is this a change? I would submit it is, right? Now, I don't know if it's the end of a cycle. I don't know. But it's certainly a change in the general flow. You could say, well, it was true here. Yeah, this was still coming off of that the need to create artificial supply to meet excess demand. It's got to get covered. That's the process that happened here. I can't tell you yet if that's over, but it's certainly a change in the general nature. So those are things to watch. And you could do this with any semiconductor. It's just or any stock. If you want to know, well, why is this stock not performing? Go look at the supply demand balance. To me, SanDisk is really interesting. Is this a repeat of that, where you had, once again, demand outstripped supply, Citadel et al. Created stock, which they can do, exemptions to Reg SHO, Rule 203b2. Then they cover it. Is this a repeat or is it the end of the cycle? Well, I don't know, but it would make me, I certainly wouldn't buy it here. I would want to know that continues down. It's above trend, but does it look bad? No, it's below 50%. It's still not bad. You're unlikely to get caught out, but do you want to do that if you're chasing this frenzy in chips so that you know where we are in that cycle? Let's do a couple more. And I'm happy to, if you want me to look at something, holler. And we can do that. Just interrupt me because I won't maybe see the chat. So you look at Intel. Here was the sharp increase to feed excess demand. There wasn't enough stock available. Market makers handle that, immediately cover it. It helped boost the gains that Intel had. Again, I look at it and say, well, it's not breaking down. I still, you get wary when something spends the better part of 30 days at 10. That's way, way outside the norm. For a stock to spend even 6 or 8 days at 10 is pretty remarkable. And so there's a lot of momentum there, but could it go, 50 days at 10? Improbable, highly unlikely. But I can't tell you it's over. You'll just, you look for, does this break down? Let's see, where did I think I saw that in something? Let me just look at one or two more here and we'll move to the last item. Again, Western Digital. A little change here. Is that a tell? I don't know. But notice how it stops the price from just skyrocketing. It's probably up. Then you get a change on the supply side, and all of a sudden the price isn't as predictable. And you know why. You can see it and go, well, I can see what the issue is. Maybe there's a creation of stock, and is there a slight slowdown in demand? We don't see it yet. It's still a 10, but that would cause me to be a little more cautious. The level is still below 50%, 49.5%. It's not extreme, but it's really helpful. Like you can know just about all the time if your capital is at risk or not. And it's, I take advantage of these things too. These are extraordinary times. Am I wary? Yes, I am. We'll finish with that. Okay, let me pause again to see if there's anything to address. Bear with me. Cisco. Okay, Tim, we will look at that. Candace, nice to see you. Can you explain how the passive portfolio sometimes selects names with short volume 50% plus and convergence? I know it's getting, you've brought that up. It all comes down to the supply demand divergence. If it's greater than 3, and you can get that with it, and we don't have a criteria in that portfolio for the reason that when passive money is buying something, it's price insensitive. So we did not put a short volume requirement in it. Now, when we ran the back testing on it, we didn't find any statistically significant difference in having the criterion in there. So we omitted it because it broadens the scope. It's a tacit concession to the importance of short volume. I mean, I think, we're running at 52% market wide, have been for 200 days. So that's why, though. And then in terms of seeing supply demand, they seem to be moving the same way mathematically. If the separation is 3, they could be moving the same way. It's just, it's a pure mathematical model. And I double checked it. I went and ran a couple of things. There was one we were talking about, and I thought, well, what is it? And I ran the standard deviation, and it was 3.2, and there you go. So the moment that changes, it will leave. But it doesn't. It's not dependent on pure divergence. It's dependent on the standard deviation in demand and supply. That's why. Yeah. But it is. Look, I look at it too, Candace. I'm like, is that good? Well, the portfolio's working, so. I get it. Okay, Tim, let's look at Cisco. And I like the CEO of Cisco is I get a real kick out of him. He's a good guy. One of I think I shared this with you. This goes all the way back to the first time that Cisco was in a tech mania. Right. I would go to the Robertson Stevens conference in San Francisco, and at the time it was, what's his name? John Chambers. So I got a front seat one year for John Chambers, who is the biggest hit, at the Robertson Stevens. Robbie Stevens is what we called them back then, and he could pack a room, and here we are, 20, whatever that is, 20. That would have been 27 years ago. Okay, so this, Tim, getting to 10, falling supply, pretty good. Could we have known that it would shoot up what it did on earnings? No, I couldn't look at that and tell you, other than to say, well, that's a sharp demand supply divergence. It's probably greater than 3 standard deviations. Would you go long or short that? Well, probably long. But I couldn't have bet that it would do that well. Now you have to watch it. If you've, the portfolio will buy it today at some greatly elevated price, and we'll see how that works out. But so long as it's at 10, and we'll watch supply relative to the trend. But this is very early on, and what could be that could stretch for 20 days, like we've seen in SanDisk. So could be a lot of gains to be had in Cisco. You might think, well, it's gone up this much. Why would you buy it? Well, that data might say it's got room to run yet. We'll see, won't we? Wild card is options expire today and tomorrow and next Tuesday. Those things you just never know. Okay, last 3 minutes. Let's look at what's ahead. So, what I always do, I do my quick scan of my dashboard every day. This is the first thing I look at, 5.2. We crept up from 5.1 to 5.2. In the broad market, it's not great, but when it's being led by a very narrow band, is that useful? Yes. Yes, it is. It does not stop being useful. It will tell me that despite this very narrow concentration, the market doesn't have underneath it a tremendous amount of support. I think that's very important to know. And you would not want to get caught out. If this peaks here, then I start looking at the directional trade again. Is it an opportunity for a directional trade? Well, It's getting close. We'll see. So I look across my dashboard and I always check how many companies are in here. We actually lost one yesterday. It went from 137 to 136. Where's demand and supply? It's fine. You look across your dashboard and you go, it's fine. I mean, big tech looks good-ish, but you don't look at the whole thing and go, wow, this is really something. It is very concentrated in a small part of the market. Gold, which hasn't, the price of gold has not yet caught up to what this to me shows. Like you could probably buy gold and get a return. That to me looks pretty good. So I do that. I'm going to check core parts of the market. I mean, tech as a sector is very strong at whatever it's 7.4, supply at 49.5. But again, it's coming to a peak. So I look at this and say, it's wholly dependent on a very small part of the market. That's no secret. We can see that, and we'll find out what happens. And there's a lot of discussion about a bubble. Well, it is a bubble. It doesn't mean that it's going to burst. It has all the natural characteristics. When there is no fear and greed, when there's no fear and a lot of greed, when people are overinvesting, it doesn't matter how good the opportunity is. Those are all, look, they're just basic characteristics of overextension. I mean, I'm concerned that the big tech companies are out raising money all over the planet, in euros and francs and Canadian dollars. That's an act of desperation to me. No, just kidding. just kidding. Yeah, they're selling debt denominated in Canadian. Hey, you do what you got to do. But I look at it. Yes, it is, but that doesn't mean it will break. I'll say, as I've said for a very long time, if the market moves, most of volatility is going to have to decline more than 2.5%. Volatility is 3% in the stocks. You don't see it in the VIX. VIX is a lousy indicator of what the volatility is. Then we have a problem, and that just hasn't happened. So we'll see. All right. I believe I could come up with 30 minutes of material, and that's about it. Just kidding. Any parting word? Okay, Brad, you're typing. Anybody have observations, opinions that you want to share? Here's your chance. No? Dan Eisenberg, no words of wisdom for us? Okay, let's see. Well, then, Brad, you're going to get the last word. It used to be that if a mutual fund went up 8% in 1 year, the fund manager was a hero. Yes. And here you have stocks going up 13% in a day. Yeah, exactly. No, I'll tell you, the thing I'm mystified by is why we're not looking at the market and wondering what is wrong with it. That's instead of going, wow, this is awesome. Look, we all like markets that go up, but it's unnatural for them to behave the way they do. So I agree. It's very, very odd. I knew a Brad back this would have been in the late 90s. By the way, now you have all kinds of crazy things, crazy betting things occurring. Well, I was there in the 90s, and we were all playing Texas Hold'em. It was our version of the mania of the moment. We're gambling on, not a lot, but and now you've got people. Did you see the Wall Street Journal article about these rooms where people engage in competitions, trading stuff? It's freakish, but it's the same thing as Texas Hold'em. Anyway, this fund manager told me then, he was very successful. He said, I'm just trying to be right 51% of the time. That's it. And to your point about something going up, having an 8% year used to be awesome. So all of these things are signs. Yes, I do, Tim. I think days to expiration options play a key role. You have the conflicting delta hedging and gamma hedging. I won't explain those, but they're offsetting effects. The underlying versus your exposure to the option, and by the end of the day, it resets. And if 60% of the market is those things, how would the VIX be reliable? What could the VIX tell you? So I'm not looking at the VIX. I'm looking at the underlying basket, which is getting steadily more volatile. And I think it can show up suddenly because there's where if that fails, if that mechanism fails, as I've said, if there's something fails in that mechanism, we're in trouble. the market moves all of its volatility, we're in trouble. None of that stuff has happened. Yeah. Okay. That's not, now let's finish on a positive note. We can see it all. We can see demand and supply. So always check it. And if we look at the signs and go, that doesn't look good, then that's time for us to be very, very careful. Okay, we will see you next week. Thank you for spending time here. Appreciate it. Always good to see you.